Hi there, a very good morning and good afternoon to all of you. And this is me, Simply Stocks, with another live session, slightly earlier than what was expected because there is an urgent work that has come in, and I have to leave for that in next 20 minutes, half an hour. So I wanted to give you a session because rather than making a video which would have taken me a long time, I wanted to have a session in which I discuss about management quality in detail here and just answer your queries because there is a commitment to do a live session, so I have to do that. I did not want to cancel the session altogether. So, being a Sunday, I know a lot of you might be waiting for this session. Uh, so I'll talk about the management quality straight away, and then I'll answer your queries, and I'll have a video also probably in a week's time or so on how to check management quality. That would be a detailed video, but here in just 5 minutes, 6 minutes, I'm going to just point out the ways of how to check into whether a management is good enough or not, or what do I do in order to check the management quality. uh, so here we go. And I'm not going to give you any examples or company specific names, but I'm going to just tell you that there are six, seven, eight pointers that one has to be careful about. Number one point is disclosures. So everyone needs to be aware of what the disclosures the company is doing, and whether those disclosures are in the interest of shareholders or not, are in the interest of people who are invested into the stock, and whether the company is doing the right thing. And one has to be very clear about what sort of disclosures are coming out of the company and from the management. So in that regard, what happens is, if the company is disclosing a lot, JVs, or you can say partnerships, or other, you can say expansions, etc., day in day out, that is also a red flag. Or if the company is disclosing very less and not disclosing anything, and then they come up with results, and then you end up looking at the results and you're saying that where did this debt come in, or how did this money come into the picture, where this money came in from say an ex company that was not part of the original company. So then you have to be very careful that okay, the management might not have disclosed a lot. So there could be two extremes to it, that the management is disclosing a lot of things, and at the other end the management is disclosing virtually nothing. In both the cases you have to be very careful, because this has been the modus operandi of companies which have fallen a lot. I'm not going to name, but there are companies that have fallen vertically in recent past, in the last 1 year or 2 years, in which there have been unlimited disclosures. A number of disclosures have come in, and they were too much, and eventually there were disclosures about joint ventures and partnerships, and opening up, you can say, opening up schemes here and there, everywhere. And it came about that they don't have the joint venture at all. So that's why we have to be careful on both the fronts while looking at the companies. Second thing you need to look at is past management decisions. Now this is the most crucial part when you're looking at a company and looking at a management of the company, how the management has done over the last 10 years. First of all, the management has to be part of the company for the last 10 years. That's one thing. And second thing is, the management needs to be there for 8, 10 years, and doing the business for the company. Whether the decisions made by the management was in the interest of the shareholders or not, that has to be taken into account. Whether the shareholders have benefited through it, whether the company, whatever expansion or whatever decisions that they have come up with, has helped the share price go up over the last 7, 8, 10 years, 5, 6 years. How were those decisions, and how did they impact the company overall in terms of profitability and sales? You have to go back and look at it. What all major, you can say, changes have happened with respect to production, with respect to the working of the company, and how the management has treated, and you can say, phases in the market or industry, everything. So that is the thing. So management decisions need to be scrutinized, It takes time. It takes probably a week's time to analyze that, look at what the disclosures have come in, what have been the management decisions, and whether it is helpful for them or the shareholders, and how the stock has performed. Third thing, and this is quite simple, but most people don't do it. But if you really want to find out, do this first. Do a Google search. So the most important thing is to do a Google search of how the company is. So suppose X company. So I'll search like fraud in X company, or BSC fines X company, or SEBI fines X company, or there is a fraud in this company that. So use words like SEBI fining or SEBI having restrictions, and use that company's name, or find out with the name of fraud, and let's see what comes out. You might end up having some idea of a past, you can say, blemishes that the company might be having, and then you could be saved a lot of your money if you are not, if you are investing, about to invest into the company. So do a Google search with few keywords, and with respect to the company, and hopefully you will have a better idea. uh, all right. The fourth point I want to bring in here is promoter salary. So one has to have an idea as to how the promoter is taking the salary, whether it's taking a lot of chunk from the profits as its salary, or it is reasonable. There is a reasonable amount that the promoter should be taking. And you can look at very good quality, high quality management, say a Reliance, a DMart, etc., or top quality management that you talk about, Asian Paints, or anything of that sorts, and compare it with your company, that with whichever company you're analyzing, and you will have an understanding of the proportion of the salary from the profits that the management is taking home. If it is huge and if it is fluctuating over years, then it is a red flag that the management is more keen to uh, means bulk up their coffers rather than working towards helping the shareholders, etc. So you have to be careful on that front as well. Another point I want to bring in here is how company behaves in tough situation. And this is also extremely necessary. So one needs to have an understanding as to how the company would be behaving in very difficult situations, in situations where you can say the industry is going through a very difficult phase. Say, for example, Maruti Suzuki, the stock went to 4,000 recently. Maruti Suzuki, the stock went to 1,000 or below 1,000 during the Gurgaon crisis when they had that plant in Manesar and the issues in 2011-12. But they have come out trumps with it, and look at how the stock has performed after that. It became 10x, such a large company becoming 10x over 8-10 years. So that is the kind of management you have to look at, that how they have performed during crisis, how they have performed during situations where many companies have shut down, many ancillary companies have shut down. So look at how the performance have been in the past by the management in those times, how they have curtailed cost and still brought about profits and everything of that sort. Okay. Another thing is whether the management is too focused on share price movement. This is also crucial. If the management, if it feels like that the management is focused on movement of share price, and they are very worried their stock price is going down, so let's make an announcement and the stock will keep up, or let's say good things about the company so that the stock is up. I'm not saying something fraudulent, but something that could be avoided, and you could have talked about something else about the company rather than saying only good things. Second thing is the management would not be keen to take risk for losses on the short terms, for gains in the long term. And if the management is not keen in taking risk, then there is a problem for investors who want to invest into the company for 4, 5, 6, 8 years. In that case, what will happen is, for short term gains, management will miss out on long term opportunities and will miss out thwarting threats on a long term basis. And I cannot name the company here, but many companies in the electronic manufacturing, many company in the mobile domain did that they wanted to be in the short term game, and did not foresee what changes were taking place on a long term basis. So companies or management that is focused on short term profits or short term stock movement should be avoided, and you would know it once you will have an understanding as to how as to how the management is talking about, whether they are talking a lot about the stock, whether they are talking a lot or worried about you can say stock price movement. I'm not saying that companies who are not worried about it are good. I'm saying there has to be a balance to it, so one has to be careful about this as well. Another thing I want you to focus on is debt levels. So whether the company has developed a lot of debt or not, whether the company has over years, the management has looked at creating value through increasing debt. One has to be careful about it, and one needs to have an understanding as to how the debt levels have been over the years. So over the last 8-10 years, how has the company been doing, how has the management treated situations in which they have to increase equity, or they had to increase the number of uh, or expand into different markets, and yet take in loans, or either use it through internal accruals. So one needs to have an understanding of how the company has behaved over the years in situations where they would either have to take loans or use internal accruals or cash balances to work out things or expand into different markets. What have they chosen? And is the company expanding too much relative to their, you can say, ability, and taking a lot of debt? That is a strict no no. You have to go back into past and look at how the management has done over the last, you can say, 4 to 5 years. So basically, you need to look at the last 10 years, you can say, track record of companies, how those companies have done over the last 10 years on the basis of all these fronts, and whether they are good enough to work on those on those front. If they have done well, then there is a case for you to invest into the company, uh, or look at other parameters before investing into such company. If you believe that the companies are, or the management have done something iffy, then you need to avoid the company, even though it looks like the company is going to be very profitable going forward, because then the numbers could be in question. So one has to be very careful while investing into companies, looking at the management quality. All right. So basically, what you need to do is back those who have a solid history. And that is why people or large investors, or you can say mutual funds or bankers, etc., they invest into companies uh, which have a 10, 12-year track record, which are more or less mid and large caps, rather than companies which are more into a smaller domain or micro cap. This is because of the management quality, because you never know which company will go under and you lose all your capital. There have been many examples during 2018 and 19, where companies that were doing exceedingly well during the 2015 to 17 phase went down under and did not perform up to the optimal level. So these were the basic points that I wanted to bring forward with respect to management quality, etc. Uh, One thing I want to do bring to your focus, that I'm going to come up with a video very soon, probably by next week, in order to let you know in detail as to what to look at while looking at the management quality of a company. Yeah. So I'm ready to answer your queries. Whatever queries you'll be having, kindly put that forward and I'll answer them. Sure. I would say avoid TV18 at the moment. They are doing well because of the revenues that are coming in from advertising, etc. Because of the fact that there is work from home. So one needs to be careful while investing at this point of time, when the economy might be opening up over the next 2 to 3 months. Kilpest for me, very good company currently. Anything below 350 would be good level to buy, but again, it's a good play for 3 to 5 years. That would be my assessment. I would say avoid Gati. I think Blue Dart is a much better option than Gati while getting into it. I know it is per stock expensive, but still Blue Dart is a better option to go with. Tata Chemicals has already run up a lot. I would say avoid most of the Tata stocks. I think other companies or other, you can say, management have performed much better and have made a lot of wealth for consumers. Gillette is a very good play for 5 6 years. Yes, it has not performed that well, but I believe that next 5 years could be very good just because of the fact that there will be more people shaving rather than going to a barber's shop. It's simple as that. Even if things open up, I think there will be more people using the products of Gillette now rather than before. I think it's a good investment bet from 5 to 8 years perspective. I would avoid Can Pharma. I think it is slightly expensive. Wait for declines to buy into it. Himadri has never been my favorite. I think Himadri chemicals will only perform when EV comes back into picture, electric vehicles, everything. At the moment, it's an avoid. I would say avoid Sundaram Finance and especially these auto finance company, other finance company, they have done well over the last 1 2 months, may do well for the next 2 3 months. But if you want to invest into companies which are more stable and generating cash. I would say that. I would say the picture is clear that the movement of Kilpest for the COVID and everything is over. I think that play is over for the time being. But over the years, Kilpest is going to gain a lot of traction based on the kind of products that they're serving to different, you can say, segments and all. All right. Just give me a second. कर नीचे गैरेज में गैरेज में अच्छा 5 मिनट रुको okay. The IT sector may perform well for the next 1 year or 2 years. So I believe that next couple of years could be pretty good. But I think for investment from a long term point of view, I would still say it's an avoid. Lotus Lab is good. I think any declines to 250 to 57 would be good opportunity to buy into Lotus Lab. But again, have a good 4 5 year time frame. I think there would be a long term consolidation into Lotus Labs. NLC and PTC, I would say avoid both the companies. I think it's better to avoid such companies. Reliance could go down to 1750, 1800 good levels to get into. Probably another 5 6% downside would be good levels to buy into Reliance. I still believe in a 1 year time frame it will give very decent returns. Avoid Apollo Tyres at current prices, I would say. Acrosel can be bought at current levels and on declines. I think it's a very good company from a long term point of view, but have strict stop losses in place for Acrosel as well. All right, guys. Thanks a lot. I need to move for some work, and that's why I came in slightly earlier. Would have a decent live session on Thursday, hopefully. Thank you. Thanks for your time, and kindly subscribe to my channel. Thank you.